Good day and welcome to Sailor Today International Maritime Radio. The Strait of Hormuz has remained one of the world's most closely watched maritime choke points over the past several months. While shipping continues to adapt to an evolving security environment, questions remain about maritime insurance, war risk premiums, and how ship owners, charterers, and cargo interests are responding to the changing geopolitical landscape. To help us understand these complex situations, we are delighted to welcome Balasundaram R, Head of Marine Insurance at Policy Bazaar for Business. With more than 4 decades of experience in maritime insurance covering cargo, hull, war risk, and specialty insurance, he has closely witnessed how geopolitical events translate into real world decisions affecting ships, seafarers, cargo owners, and insurers across global shipping. Mr. Balasundaram, thank you very much for joining us today. How are you?
I am good, and my pleasure to be here on Sailor today. Yeah.
Yes, it's absolutely great to have you and to have your voice addressing these very pertinent issues that the shipping industry is going through, right? So, we'd love to get to know a little bit more about you, but I have a couple of questions that we can start off with. For listeners who may not be very familiar with how marine insurance responds to geopolitical situations and events.
So let me put it this way. Marine insurance is a very generic term. It has many subdivisions. One, you call it as the marine hull insurance, which is the insurance coverage for the vessel itself. The second portion is the insurance for the cargo which these vessels carry, which is marine cargo insurance. So there are two segments here. Coming down to the coverages also, it can be broken up into two further. As far as cargo is concerned, one portion is the marine coverage for cargo, which is coming under the institute cargo clauses, which will give you an all risk cover or a limited cover. But there, war risk is an exclusion. So war and strikes risk are separately purchased by attaching the institute war clauses and institute strikes clauses. Same is the case with hull. Whereas the hull is covered against a number of perils, war is an exclusion, and war risk gets added to the hull coverage separately. So both are distinct coverages, though in practice, everything is sold together as a combo. So now what happens is, in a geopolitical situation, the greatest threat remains the threat of war, a physical damage to the hull or the cargo caused by the war, a missile falling on it, or a subsea mine exploding, or a bomb falling on it, something like that. Whereas the other generic risks always remain. Like, for example, a vessel could sink because of a breakdown. The cargo could get damaged because of an accident inside. So those risks remain. So what happens in case of a breakout of war is that underwriters tend to look closely at the war risk side of the business, because that is where the impact is likely to be humongous. It's not going to be a small loss, it's going to be a very huge loss. So the basis of underwriting varies between the generic cargo risk or hull risk and the war risk. War risk is the one which is more prone to be in place when there is a actual breakout of war. So here is where the situation becomes complex. When there is a breakout of war, a very close methodical follow-up is done by the underwriters to ensure that whether they should continue with the war risk coverage at all, and if at all they continue, on what terms and conditions, or they should totally pull out of the coverage. So this is the threat, because the war damages could be huge. So this, in essence, is the background. So whenever there is a geopolitical issue like a war, this is one aspect of it. There is a second aspect, a geopolitical, you can call it, when there is terrorism. Like, for example, even today, what we feature in the Strait of Hormuz is a war, whereas what is happening around the Yemen and Red Sea area is terrorism, the Houthi rebels. So that does not fall under war risk, it falls under strikes risk. So there is a distinction, war and strikes and the basic cargo risks. So that should be my opening remarks for this.
Thank you for that. We wanted to ask you, when it comes to insurance in this for this particular war, is that applicable on only some? Now a company would have multiple vessels, right? Does this
Yes.
insurance coverage, when it comes specifically to the war, cover only those vessels which are going through those routes, or is it for the entire? Is it like a blanket coverage for all of the vessels? How does it work?
In the normal course, a war risk cover and a strikes cover applies for the vessels on a worldwide basis. Whenever there is a regional tension, what the underwriters do is that they limit coverage or pull out of coverage for specific geographies by longitude and latitude. They say ships plying in this particular area within these areas, we are going off risk, or we are revising the underwriting terms, or we are putting in additional guardrails. So even now, whenever there is talk about cancellation or enhancement in premium, that is applicable only to the war and strikes portion and not to the main hull or cargo portion. That coverage continues unhindered.
Okay. Thank you for clearing that. That was really important. Why is this region so significant for global shipping?
Okay. If you look at the map, the major oil fields are in the areas surrounding the Persian Gulf. And that narrow choke point, as you said, is the Strait of Hormuz, which is the uh, pathway to the entire world. Petroleum is produced largely in Iran, Iraq, Kuwait, UAE, Qatar. Qatar produces more of gas, Bahrain, Saudi Arabia on the eastern side. All these ports, if vessels sail out of these ports, they have to pass through the Strait of Hormuz, which is a narrow 33-kilometer pathway, which runs into the waters of Oman and Iran as well, before it comes out into the open Arabian Sea and to the rest of the world. And this constitutes around 20% of the total oil trade of the world. That's one. The second important reason is that fertilizer also comes to a great deal from the Arabic countries towards the rest of the world. So that also constitutes a major thing. Coming to the third point, all talk is still centered around the Strait of Hormuz and how it affects the oil trade 20%. It's a big thing, no doubt about it. But what people are not talking is about the reverse traffic. Many of the Gulf nations require commodities from other countries, which includes edible stuff, food grains, meat, chemicals, machinery, many items which need to go into the Persian Gulf through the Strait of Hormuz. So now, even if it opens or is at partially opened, we have different news coming in. What is opening is primarily vessels trapped in the Persian Gulf are coming out. What about vessels which need to go in? So till such time, we cannot say that normalcy has been restored. Two-way traffic should be there. Vessels going from the outer world into the Persian Gulf ports through the Strait of Hormuz, and the vessels coming from inside to the outside world.
So now I want to ask about a perception question. There's a perception that once shipping routes reopen, insurance costs should immediately return to normal. However, you have pointed out that this may not necessarily happen. So why do war risk premiums often remain elevated even after the immediate crisis appears to ease?
See, let me put it this way. Insurance is an industry which operates for the long term. It is not like the stock markets which react to news. If there is a news, positive news, immediately it shoots up, or negative news, it falls down. Underwriters are much more circumspect. They think 100 times. So what happens is, even when the rates went up, no sooner the invasion started, the war risk premiums did not go up. They heightened gradually. And come to think of it, This is not the first time the war risk premiums went up. So, which again, people have a misconception. In India, especially if you see, right from around 2021 or whereabouts, I don't remember the exact date, war risk cover has been cancelled by underwriters for all cargo ships going into this high risk area, as they called it, the entire Middle East. But there was a proviso that you could buy the war risk cover at an additional premium, which was available. So it was always there. Now, when the actual war broke out, people waited for some time, a few days, a week perhaps, before they said that they are going to restrict coverage or they're going to charge a still higher rate of premium, which is how it happened. It went up gradually. It is not a knee-jerk reaction or a quick fix reaction. Going by the same logic, even when you say that it has been opened, the Strait of Hormuz is now opened or likely to be opened, you don't expect the prices to come down immediately. The war risk insurance premium will continue to be high. To my mind, at least to 3 to 4 months, it should continue to remain high at the levels where they are at the moment. Not that it will go up further, but it will continue. Because still, the underlying facts of the agreement have not been known. And we do not know how many mines are there in the sea. And whether there could be some sort of sniper attacks, we do not know. So actually, the news is also quite censored, I would guess. So you don't expect the prices to come down from an insurance standpoint immediately. Insurance doesn't work that way. There is a gradual increase and there will be a gradual slide down only. It works more on actual risk perception by the underwriters. So to me, it appears 3 to 4 months would be the timeline after everything comes to normal, that the prices will gradually start coming down. But this is one part of the story. Before you ask me that question, actually you should have asked this question of the shippers and the shipping companies. Now that the Strait of Hormuz is opening or it has opened partially, whatever it is, are you willing to risk taking your ship with the cargo there? Most shipping companies are not as yet. Right? So still cargo is stranded in Indian ports awaiting shipments to the Gulf countries. Ship freight charges are also high. So a shipping company would also look at it, insurance or no insurance. They want the safety of their ships, their crew, the cargo, etc. So first question to be asked is whether shipping companies deem it safe, absolutely safe, that they can start flying from tomorrow. Or the shippers also say, okay, I'll send the goods now to you. It's not so. So I think people are putting undue pressure on insurers whether the price will come down. No. The first question to be asked is whether the ships are ready to sail.
It's more circumspect, and the underwriters take a lot of precautions, a lot of calculated measurements before making any changes. So this next question goes in line with that. So apart from the actual security situation, how much does confidence, market sentiment, and the underwriting outlook influence pricing? So in what I'm trying to say is that, apart from actual numbers, what does perception have to do with it? Or does perception not affect it at all?
No, perception, that is a perception, that is a reality. Both are impacted today, right? The perception is the war is still not far from over and the Strait of Hormuz is not the same toll-free passage as it was earlier. That's a perception. The reality is perhaps we have passed the worst phase of the war. There is no more firing, no more bombing. But still, whether ships are able to ply through safely, answer is no. So the question is, what exactly drives insurance pricing is the question you're asking. When an underwriter looks at this, he looks at the actual risk at stake, then there is a perception which he tries to factor into that. Apart from this, a large thing to be considered is the demand and supply also, which basically drives markets. And the war risk underwriters are a selected bunch. So if you have more supply tomorrow, maybe even in a war-like situation, the premiums may not have risen to this extent. Maybe there could be a slight difference. give you an example, uh, when the war risk premiums were at an all-time high at around 50% up from the normal course, etc., India came out with its own mechanism called the Bharat Maritime Insurance Pool, wherein they said that they would provide a consortium of Indian reinsurers and insurers will provide cover to Indian ships or Indian cargo coming into India or going out of India to the high risk area in the Gulf region at a particular price. So they were offering war risk. They are offering war risk cover. And this war risk cover is at a discount to the international price. Even though it may not, it is higher, but not as high as the international price. So this has forced some of the international players also to drop price a little. So it's more of a demand and supply, perception, and actual risk.
Got it. Very well answered. Thank you for that. It's not just perception, it's not just numbers, it is also demand and supply. Perfect. Now, what changes are you currently seeing in the marine insurance market?
Okay. So right now, what's happening is some of the shipping agents lines are taking a circuitous route to these Gulf ports. So supposing something were to go to, say, Abu Dhabi, they drop it at Oman, one of the safer ports in Oman, before the Hormuz Strait, and then they move it by road to the interiors. Or what they do sometimes for some of the cargo is shipped to the western coast of Saudi Arabia, the Jeddah side, and from there it moves by road. So what it involves is a longer time duration, higher freight costs, and more possibility of handling risks, multiple handlings. So it's a question of time, money, and safety. Everything is getting impacted. This is what people have been doing now. So trade is happening, but then it adds to the cost of the shipper. Ultimately, it boils down. There is no free service. There is some element of sharing, but then ultimately it is getting passed on. So another greater worry now is that supposing tomorrow the Strait of Hormuz opens, will it remain toll-free as before? Or as is mandated by the United Nations law of the sea? Though if there is going to be a fees or a toll or an insurance or protection, by whatever name called, it is going to add to the cost of products. And ultimately, the shipping companies would pass it on to the goods owners. So that's a concern. And the second concern is if one starts saying that there will be a toll collected here, the same can happen in other straits also, like the Strait of Malacca or the Strait of Dover, where those countries may also get the idea that let's also start charging a toll instead of offering free passage. So that's a larger concern.
Okay. And you were speaking about this earlier, but has increased competition among insurers helped moderate the premiums despite continuing geopolitical uncertainty? I know you were speaking about, other insurers from around the world. So let's talk about that.
No. The answer is no, because the international market, by then, the rates are in the same range. When the Bharat Maritime Insurance Pool, the government stepped in to support Indian businesses. They kept the price at a slightly lower level. And so the international market responded, since India was too big a market to miss out on the war risk premium. So they had also rationalized prices to some extent. It is not competition alone which is there. It is not competition among insurers, I would say.
Got it. This is the last question for this interview. Now, looking ahead, what practical advice would you offer ship owners, operators, and cargo owners as they navigate today's uncertain maritime environment?
Well, this is a question for the presidents and the heads of countries to answer, or for that matter, the United Nations to answer. But I would say that See, there's many people. You have to be informed. You have to be informed first. Stay informed and have your plan B ready. Like, for example, I would say that many people approach us for war insurance. They say that I have a contract in the Middle East. What price you can get me the war insurance cover? The first question I asked is your vessel sailing at all? First, make sure about that. So, what happens is that there are many Indian exporters, especially on commodities like rice, who have brought their containers to Indian ports and they have been lying here for days and weeks together because there are no vessels sailing into the Pacific. So what happens here is that because of the delay, there is a lot of risk involved, and delay there anything caused by delay is not covered under marine insurance. So what I would say is you have your plan B ready. Don't take things for granted. And as far as ships are concerned, obviously, SOLAS convention is there. They have to see the safety of the crew as well. So they would not be sailing into areas where it is an iffy situation. So that being the case, I think uh, needs be that you need to have your plan ready. Like I said, many of the Indian exporters have been unaware or uninformed that war risk cover to the Gulf countries was not available since the last 4 years. No, as a normal course, it was not provided by the insurers, but then you could have bought it at a slightly additional premium. It was around 0.05%, which most of them have not purchased. So be prepared, be aware. And I think diversification of markets is, of course, essential. If you're having only one buyer or one seller, I think you may get badly hit. So that's about it.
Balasundaram, thank you for sharing your valuable insights and helping us better understand an area of shipping that often remains behind the scenes but has a significant impact on global trade. Marine insurance is far more than just financial safeguard. It reflects changing risk perceptions, geopolitical realities, and the confidence of the global maritime community. As events continue to evolve, informed decision making becomes increasingly important for ship owners, operators, and cargo interests alike. Thank you once again for joining us on Sailor Today International Maritime Radio.
Thank you very much.